Good morning, everyone, and welcome to today's webinar on the 10 key clauses to consider in a commercial contract. I am Susan Wells, an associate in the business services team, and I sit within the commercial contracts and technology sub-team. And I'm joined today by my colleague, Francesca Lombardi, a solicitor within the same team and sub-team. I'll just begin with a few housekeeping items before we move on. So the webinar is being held remotely, so please bear with us should we experience any technical difficulties, and we'll aim to resolve them as swiftly as possible. We will be taking about an hour today, and that will include taking questions at the end. So all attendees are on mute. So if you have any questions, then please do leave them in the question box appearing in the control panel on the right of your screen, and we will endeavour to answer as many as we can at the end of the webinar. Alternatively, we will email you afterwards and get in touch directly, and you can also get in touch with us through the phone numbers and email addresses appearing at the end of the presentation. Also, if there are any commercial contracts topics that you would like us to cover in the future, then please do let us know and we'll see what we can do. There will be polls throughout the webinar, so please get involved with these so that we can make sure we do actually have someone listening on the other side. So the slides from the webinar are available to download whilst the webinar is in session, and this can be found in the handout section. The webinar is being recorded, and this will be sent to all attendees later today. Please do share that link with any colleagues who will not be able to attend. We would appreciate any feedback that you would have on this webinar, so please complete the survey that will appear on your screen once the webinar ends, and you will stand a chance to win a John Lewis voucher. So to kick us off, we are going to do our first poll. So please could you answer the following question, which should be appearing at your screen. There we go. I always read the entire agreement before I sign it. So the first answer is yes, of course, I read everything before I sign it. Or the second answer is no, I cannot be bothered. Usually the document is just too long. So we'll give you a few seconds just to answer that. Oh, 90%, that's very interesting. I thought it might be a bit more of a mixed bag this morning, but good to see that most of you do read your contracts. I think this is perhaps an indication of how we approach contracts in a professional and personal environment. So some contracts are, of course, more important than others, and this will influence the attention we afford them. We may not read the terms and conditions of our internet provider, but you may be familiar with the terms of your tenancy or mortgage agreement. So more often than not, though, clients will ask us, why is the contract so long? Can it not just be 2 pages? So hopefully our discussion today will highlight why it is important to cover the main clauses in a commercial contract. So Francesca and I will be covering 5 clauses each that you would normally expect to find in a straightforward services agreement, and the most common points of contention that may arise between the supplier and the customer. So we have tried to keep this easy, digestible. So if there are any additional points that would you like us to clarify on, then please do drop them in the question box and we will do our best to answer these. I also just want to highlight that we will not be discussing data protection provisions today, but our colleagues Catherine Ripley and Charlotte Burrows recently presented a webinar where they covered this topic in detail, and you can find this on our website if you are interested. So the first key clause we will be looking at today is the commencement and duration clause. So commencement and duration provisions are often rolled into one clause, but we'll have a look at each of these separately. So let's start with the commencement clause. So it's important to know that a written agreement will take effect immediately when it is signed, or the date of the last signature if the parties signed on different dates. So this will be the case unless the parties have expressly provided for another commencement date, or the contract itself is subject to one or more conditions precedents. So we don't see this very often in the services agreement. Conditions precedents are more prevalent in funding, corporate and property transactions. But if, however, a contract is expressed to be subject to a condition precedent, then no binding contract will exist until the condition precedent has been satisfied. Or the party's intention indicate that they otherwise intended the contract to commence on some other date. So this will be an implied term, and the preference would be to have an express commencement date if the date an agreement comes into effect will be a different date to when it is signed. It does sometimes happen that parties have already started performing their obligations before entering into a written agreement. So if they want the terms of the agreement to apply from the date they started performing the obligations, they can agree an effective date, which will be a date in the past. Please don't backdate your documents, rather agree a different effective date. So this will more often than not be a commercial decision for the parties to agree on, rather than a legal discussion. So the second leg of this clause is the duration provision. So as the name suggests, a duration clause sets out the duration, also referred to as the term of the agreement. So where a contract is silent on the term or termination rights, it is likely that it can still be terminated on reasonable notice on part of one or both parties. So the law in this area is, however, murky, and what the courts consider reasonable very much depends on the individual circumstances of the case. So it is better to clearly specify the duration of the agreement and also the termination rights to avoid any dispute on this later down the line. So when a contract is stated to have a fixed term, the parties will often intend for the contract to terminate automatically at the end of the term. Sometimes a fixed term contract expires, but the parties carry on acting in accordance with its terms. In this situation, the courts may infer that the parties have agreed that the contract should continue, or that a new contract should come into existence on the same terms as a previous contract. Suppliers will often try and negotiate a longer fixed-term contract to lock in the other party and to ensure financial certainty for a set period of time, where the customer may be more interested in a shorter fixed-term contract with the option to extend the term or renew the contract if the performance of the supplier is satisfactory. So let's take a quick look at a straightforward commencement and duration clause. So this reads as follows. This agreement shall commence on 1 January 2022, or the commencement date, and shall continue unless terminated earlier in accordance with clause 10, termination. So until the 31st of December 2022, when it shall terminate automatically without notice. So there are three elements to this clause. Firstly, we have the commencement date, which is the 1st of January, or sometimes you will have a defined commencement date, which will then replace the actual date included. So the second leg will be the termination date, which in this case is the 31st of December. So we have a 12-month contract here. And then you also have the little bit in the middle saying that the contract might terminate earlier if either of the party uses their termination rights under clause 10. So that's the commencement and duration clause, and Francesca will next be looking at obligations.
Thank you, Susan. Good morning, everyone. Thank you for joining us today. I'm going to take you through one of the key clauses in the contract for services, which is on obligations. The contract will normally set out what the parties agreed to provide and to which standard. There will be two clauses, one normally dealing with the supplier's responsibilities and the other dealing with the customer's obligations. I'm going to focus today on the supplier's responsibilities. Naturally, the supplier will want to keep these as short form and lenient as possible, whereas the customer will be on the directly opposite approach. We'll have a few key sticking points for negotiation, and I've picked up the most important ones. They will normally be around the service description, the quality of the deliverables, the service standard, and any performance dates. On the service description, when describing the supply of services and any deliverables, the supplier is likely to want to qualify its obligations, and that will be with wording such as providing the services using reasonable endeavours and in compliance in all material respects with the agreement. This is rather than tying itself to absolute obligations. On the other side, the customer is going to want to ensure that the services are provided in accordance with and comply in all respects with any agreed services details. On the quality of the deliverables, the customer is also likely to want confirmation that the supplier will ensure that any deliverables are fit for any purpose, whether expressly or implicitly made known to the supplier. Likely, the supplier is going to want to resist this. The service standard, there is an implied duty under statute for the supplier to carry out the services with reasonable care and scale. This is not something that is normally opposed by the supplier, but at times customers may ask for this wording to be amended and introduce a higher or more industry-specific standard. For example, with wording along the lines of a supplier of the services in accordance with best practice in the supplier's industry. Finally, I'm going to talk about the performance dates. The contract will normally set out any agreed milestones or performance dates. The supplier is likely to want to refer to these as estimates. This is to avoid time for performance being of the essence. The meaning of time of the essence legally is that if there is a delay, the customer can terminate the agreement. Naturally, the supplier is going to want to avoid this at all costs, whereas the customer is going to want this right, especially if performance dates are particularly crucial under the contract. At times, customers may also want to ask for additional remedies in case of a delay, and these can include the ability to reject any subsequent performance or to purchase substitute services, as well as hold the supplier accountable for losses or costs incurred as a result. I've prepared now a little visual aid of an example wording for a clause that the supplier is likely to prefer for the service description or standard. And it will read something along these lines. The supplier shall use reasonable endeavours to supply the services and deliver the deliverables to the customer in accordance with this agreement in all material respect. Reasonable endeavours means that it's not an absolute obligation, and in all material respects naturally implies that anything non-material will not be a breach. I'll give the floor back to Susan now, who's going to take you through the payment obligations.
Thanks, Fran. So the payment terms under a contract will vary depending on a few factors, such as the services to be provided or the parties' respective business models, as the payment terms will have a significant impact on cash flow. So payment may be in advance or in the long-term supply arrangement as set payment periods, most commonly monthly or quarterly. Some businesses prefer to use their own accounting period, for example, fortnightly or 4-week periods. So key payment terms you would usually see in a services agreement are when payment is due. So the supplier will prefer a shorter payment period of its invoices, where the customer will often push for a longer period. The method of payment, often by electronic bank transfer. We hardly ever see checks mentioned these days. The right of set-off. So this is a right of the supplier may want to exclude any right of set-off, meaning that the customer cannot deduct any amounts due from the supplier to the customer against the charges owed to the supplier before making payment. You will also see consequences of late payment, such as interest to be charged on overdue amounts, or the suspension of services. So I will discuss interest in a bit more detail. A mechanism for disputing invoices in good faith, and in international contracts, you may also see the currency in which payments is to be made. So if a contract is silent on particular matters relating to payment, case law or statute will imply terms to bridge the gap. For example, where no time for payment is stated, the buyer must pay on delivery, or when no place of payment is agreed, the buyer must make payment at the seller's place of business. So let's take a closer look at interest on late payments. So under the Late Payments of Commercial Debts Interest Act 1998, there's an applied term that interest may be charged on late payments to at least 8% interest on the contract price. So parties often agree to include an express term in the contract, allowing a supplier to charge interest, and often agree an interest rate between 2% and 4% above the published base rate. So this base rate will often be the supplier's bank or the Bank of England. So parties can go higher than this, but agreeing too high a rate could be unenforceable as a penalty. However, where the Late Payment Act would apply, it might be hard to argue that a clause matching the statutory rate of interest is unenforceable as a penalty. Suppliers will, of course, push for a higher interest rate, especially if the customer is known for being a bad payer, where the customer will want a lower rate to apply. Francesca will next be looking at limitation of liability.
Thanks, Susan. I'll take you through now the most important clause in a contract, which is the limitation of liability clause. It's always a key issue in a services contract, and it's the one clause that is likely to be the subject of heavy negotiation between the parties 9 times out of 10. The supplier will naturally be the performing party under the agreement, and so it takes on the greater risk. For this reason, the supplier will in no doubt want to include the limitation of liability clause in the contract. This is because without limitation clause, there is no financial limit on the damages that the customer could potentially recover. On the other hand, the customer may sometimes take the view not to include this clause, meaning that its own liability would be unlimited, but the customer may be prepared to accept this risk if its principal obligation is just to pay charges that have been agreed. There are a few sticking points. I've tried not to get too legally technical and keep it more commercial here. They will normally gravitate around the general liability cap, whether any indemnities are included under the general cap, any higher liability caps or super caps, and any excluded or included heads of loss. The general liability cap is normally a clause which seeks to limit the supplier's liability under the contract to a capped amount, while the supplier is likely to want this amount to be tied to the fees that it's getting paid by the customer under the contract. The customer at times may insist on either a higher fixed amount or a higher percentage, for example, something in between 150 and 250% of the fees paid. In terms of the indemnities, as Susan is going to explain shortly, the contract is likely to include certain indemnities from the supplier. Whether these fall under the supplier general liability cap or whether they are unlimited is normally a point of contention, with the supplier pushing for inclusion in the cap and the customer being at the opposing end of negotiation there. There will also be times when customers may ask for higher caps of liabilities. This is in case there are liabilities likely to be substantial or to incur high fines, and so they may eat into the general cap. And they will normally cover data protection breaches or any damage to property. Whilst the supplier may be inclined to agree to these because there is a commercial reason for asking for higher caps here, the key point for contention would be in terms of the amount or what higher amount can be feasibly agreed between the parties. Finally, another key point for negotiation would be around any types of losses that the supplier may want to exclude in their entirety. These tend to include loss of profits, any other economic losses, and things like loss of data, damage to goodwill, and any indirect or consequential losses. I'm sure you will have seen these in many contracts. While the customer may well accept for these losses to be excluded, it may in turn require certain types of loss to be expressly recoverable. This is, for example, in case there are any specific key contracts that the customer can foresee being impacted in case of a breach under the current contract. I've got a little poll here for you now, where hopefully everyone will get the answer right. Will the supplier ever choose to omit the limitation of liability clause in its entirety? Yes or no? I expect great things. Don't let me down. I'll give you a few seconds to respond. Let's see. Yes, well, 67%, guys. I was expecting 90%. If you have answered yes, I'd like to know the reason, please. Thank you. Susan will now take you through the indemnity clauses.
Thanks, Fran. So the indemnity and act limitation of liability is definitely a hot topic that we get asked about often. It can get quite complicated, so I'll try and keep it as simple as possible. So an indemnity clause allocates the risk between the parties to the contract, or the clause may improve the remedy for breach of contract. So parties should consider including an indemnity clause if they want to protect themselves against risk outside their control by passing them to the other party who may be in a better position to control that risk, or to improve the remedy for breach of contract. So an indemnity clause may be omitted if existing rights already give enough protection, or if it would be unrealistic to demand an indemnity. So an indemnity clause is arguably not a boilerplate clause for the following reasons. They vary widely from one contract to another. They have an obvious commercial effect, and they tend to be heavily negotiated. Indemnities usually protect the receiving party against three common scenarios which we'll look at next. So to keep things straightforward, I'll use the customer as the receiving party of the indemnity in this scenario. So firstly, it may protect a customer against third-party claims. So without this indemnity, the acts or omissions of the supplier may expose the customer to a liability over which the customer has little or no control, such as liability for a breach of intellectual property rights. For example, if the customer is the innocent user of infringing software supplied by the supplier, or liability for defective products, which the customer has not manufactured. So secondly, an indemnity may protect the customer against the supplier's breach of contract. So without this indemnity, the supplier is liable to pay damages under common law rules. So these damages are often normally satisfactory, in which case the indemnity may not add anything. However, as Francesca pointed out, contractual limits on liability are sometimes negotiated for all liabilities except those arising under an indemnity. So in that case, an indemnity may, in practice, be a route to agreeing uncapped liability, similar to the ability for breach of damages. Thirdly, an indemnity may protect the customer against legal costs. So an indemnity against the cost of litigation to enforce a contract may increase the cost a court may award under statutory powers. So indemnity against cost incurred in disputes with third parties can give up to 100% recovery, so worthwhile considering included under indemnity provision. So Francesca, well, next we're looking at intellectual property rights.
Thanks, Susan. Yep, so the IP clause will also be a key clause. That will be particularly for the treatment of the intellectual property rights in any deliverables being supplied. These can be reports, plans, or any other physical outputs of the services. From an intellectual property perspective, there will be generally 3 categories of material used and provided in connection with the services, and the deliverables can contain elements of each of these 3 categories. I'm going to take you through each of these. Stick with me. Materials owned by each party which were developed independently before commencement of the services will be the first. Naturally, each party will normally retain ownership of these, but may need to license them to the other if necessary for the provision of or the receipt of the services. From the customer's perspective, these are likely to involve any of the customer's materials or information provided to the supplier, whereas from the supplier side, they may be software or other materials that the supplier uses with its entire client base. The second category will be materials owned by a third party and supplied by one party to the other under the contract. This will be, for example, where the supplier may need to provide third-party software, or where the customer may need to supply branding owned by a third party. Normally, anyone providing the third-party owned material is responsible for procuring a license to the other party so that they can use it under the contract. The last and most important category will be in terms of materials created by the supplier specifically for the customer in the provision of the services. The IP rights in these can be treated in one of 2 ways. The first and customer-friendly one will be for the supplier to assign all of its IP in the deliverables to the customer, meaning that the customer then owns all of the IP and can exercise it as it sees fit. The second way that the IP can be treated is for the supplier to grant the customer a license or a right to use the deliverables. As I say, the customer is naturally likely to prefer an assignment of any bespoke deliverables, and that's because it will guarantee the customer ownership and exclusivity and enable it to enforce any IP rights. The supplier, on the other hand, will prefer to retain ownership of its IP and would likely want to grant a license instead. In terms of the license, there will be normally 2 key points that can come up for negotiation. The first one is in terms of whether the license is going to be exclusive or non-exclusive, with the supplier leaning towards non-exclusivity. And the second will be in terms of the duration of the license, with the supplier likely to prefer for the license to last during the term of the agreement rather than indefinitely. I have another little visual aid here. Prepared an example wording of a clause that the supplier is likely to prefer for the IP license. And it will read something like, the supplier grants the customer a fully paid up, worldwide, non-exclusive, royalty-free license during the term of this agreement to copy and modify the materials, excluding the customer materials, for the purpose of receiving and using the services and deliverables. As I was saying, the key terms will be the ones underlined on non-exclusivity and on duration, where the parties are likely to be at odds. Susan is now going to take you through the next clause.
Thanks, Ryan. So the next clause we'll be looking at is the force majeure clause. So force majeure is a French term and it translates to superior forces. So the purpose of a force majeure clause is to excuse a party from performance of the agreement following the occurrence of an event beyond its reasonable control, which has hindered its performance or made it impossible. So the clause will also determine whether the agreement continues, is suspended, or is terminated. Because the term force majeure has no established meaning or consequence in English law, agreements often define this term, and events included under the definition will vary from one agreement to the next. Brexit and COVID highlighted this area, as these events cause a massive impact across the board, but also on the service delivery arena. Amendments to the definition of force majeure to account for the delays that arose as a result of Brexit and COVID were, and still is, an effective way to protect suppliers. The definition of force majeure should focus on events beyond a party's reasonable control, and sometimes the clause may stipulate that the force majeure event should not be reasonably foreseeable. It is more likely for a supplier than a customer to invoke the force majeure clause, and the supplier may want to consider including express events such as default of subcontractors or third-party suppliers. As in the absence of a specific provision, the customer may argue that such persons would not have defaulted if they had been more diligently supervised or better paid by the supplier. Conversely, the party less likely to invoke the force majeure clause, so typically the customer in the scenario, may wish to ensure that events such as these are expressly omitted. A customer may therefore wish to agree only a very tightly defined clause, listing only certain acts, events, accidents, or omissions as force majeure, and excluding all other possibilities. So when this clause is considered, parties should take the following into account. Are there any specific events relevant to the circumstances of the transaction which should be set out expressly to avoid any future dispute? What is the effect of the force majeure clause? Is it to release the parties from their obligations or suspend those obligations? Will one party or both have the right to terminate? So in long-term contracts, due to the extensive time and resources often involved, parties may wish to include provisions to allow for the continuation of the contract, with termination as the last resort. And then should the party relying on the force majeure event have the right to determine that such an event has occurred? Or would it be appropriate to have an independent termination if, for example, the obligations are very technical? This is an important consideration, especially if the force majeure event is undefined and the clause simply mentions events, circumstances, or causes beyond its reasonable control. So let's take a look at an example of a force majeure provision. So this clause reads as follows. Neither party shall be in breach of this agreement or otherwise liable for any failure or delay in the performance of its obligations if such delay or failure results from events, circumstances, or causes beyond its reasonable control. So the time for performance of such obligations shall be extended accordingly. If the period of delay or non-performance continues for 4 weeks, the party not affected may terminate this agreement by giving 7 days written notice to the affected party. So you will see that in this clause, the term force majeure is not defined, and it simply refers to those circumstances shown in bold, which will be appropriate in some, but not all cases. The time periods included under force majeure clause, so in this case we have 4 weeks and 7 days, will depend on the duration of the contract and the urgency associated with the delivery of the services. And then under this clause, only the party not affected by the force majeure event may terminate the contract, which, as I've mentioned, will usually be the customer in a services agreement context. Francesca will next be looking at confidentiality.
Great, thanks, Susan. The confidentiality clause in the agreement is aimed to ensure that the confidential information disclosed remains confidential and is kept secret, and that the party receiving it only uses it in connection with the purpose of the agreement and not for any other purpose. In contrast with the other negotiating points that we've been covering, the parties' difference of approach here tends to depend on who is likely to be disclosing the bulk of the information, which could be either side, whether it's the supplier or the customer. I'm sure you will have seen a confidentiality clause in many agreements before, and it's not a clause that it's normally heavily negotiated, but there are a few key points to be aware of and that can come up for discussion. The first one is in relation to the type of information covered under the clause. So the definition of confidential information will normally cover information about the other party's business, affairs, clients, or suppliers. And the disclosure is likely going to want this information to be referred as disclosed in any form, so whether orally or written. The recipient, on the other hand, may insist for clarity that the definition of confidential information is limited to information that is expressly marked in writing as confidential, thus putting quite a burden on the disclosing party, which is likely to resist this. Another key point here may also come up in terms of either party wanting for the definition to cover the terms and existence of the contract. So meaning the contract is also kept confidential. This will be particularly for the purpose of controlling any publicity or announcements in case publicity is a key consideration. The second point will be around protections in case of disclosure to permitted parties or permitted disclosure. So the recipient will normally be allowed to disclose information to its employees or contractors who need to know it so that that party can perform its obligations under the contract, and will remain liable in case they fail to comply with the confidentiality obligations. However, where particularly sensitive information is disclosed, the disclosing party can at times also require that any of these representatives enter into a direct confidentiality undertaking, which is likely to impose a heavy burden on the recipient, which in turn will likely resist this if it can. Finally, a really crucial point will be in terms of the duration of the confidentiality obligations, and this depends on the commercial value of the information disclosed. So day-to-day business information usually remains valuable for a short time frame and tends to be protected during the term of the agreement and then for a term between 2 to 5 years afterwards. On the other hand, technical information, so trade secrets, can be protected indefinitely, and so will either need to be carved out or need to be expressly subject to a longer term. Thanks for sticking with me on this, and Susan will take you through the termination provisions now.
Thanks, Fran. So termination rights should be included in most contracts, especially to allow for early termination by notice, to clarify or extend the range of breaches that justify termination, or to create a termination right on grounds of financial problems. So termination rights generally fall into two categories. So first we have termination for cause, and we'll be looking at those common causes in a bit more detail. And then also termination without cause, also referred to as a right to terminate for convenience. So parties may consider omitting termination right in shorter form contracts, but this is not something we'll easily recommend. So if a contract contains no express termination provision, the common law allows a party to terminate immediately in response to the most serious breaches. So this right may, however, be expressly excluded. A termination clause is usually recommended to improve on the termination rights the parties have under common law, and it can create contractual rights that might not otherwise exist to terminate the contract. So a termination clause typically covers the following. So first you'll have the termination without cause, and this is also referred to as the right to terminate for convenience. So a customer may want to include a right to terminate for convenience, which is not something a supplier will always be happy with. So as mentioned earlier, the supplier will want to lock in the customer for as long as possible, and a right allowing the customer to terminate at any point for any reason decreases this ability the supplier has under the agreement. The next thing that will be included is insolvency of either party. So under a fairly recent legal development, it is now difficult, or in some cases even impossible, for a supplier to terminate many contracts for supply of goods or for non-financial services on the grounds that the customer has entered into a formal corporate insolvency procedure. Suppliers would normally attempt to mitigate this by tightening the payment structure and ensure they can terminate in case of non-payment by the customer or where the customer is in financial distress, as well as a right to terminate for convenience. The next termination right that will be included is material breach of the agreement, and then also you will see a termination in the event of change of control in the party. So an agreement may also include consequences of termination, which will typically include the party's obligation on termination or expiry of the agreement. So this may include the following, if relevant to the contract between the parties: repayment of any advance sums paid, payment of outstanding amounts due, return of any equipment or materials, return or destruction of confidential documents, or termination of intellectual property license, as mentioned by Francesca earlier. So let's take a quick poll. So on your screen, the next question will appear. Would a supplier typically accept or reject a request from a customer to terminate for convenience? So would a supplier accept or reject a customer's request for a right to terminate for convenience? I'll give you a few seconds. Oh, good, well done. So yes, that's right. 88% of you got that correct. So normally the supplier would, in the first instance, reject such a request. It might be that during the negotiations they will have to concede this point, to get something else that they want under the contract, or maybe just to get the contract over the line. But in the first instance, it will definitely be the supplier's preference not to give this right to the customer. Just as I mentioned before, the supplier would like to lock in the customer for as long as possible, and ensuring that he doesn't have this right would be a way to do so. Okay, so Fran will be taking us to our final section for today.
Thanks, Susan. So save the best for last. We've got some boilerplate provisions. So I've been a bit cheeky, and we have a few clauses to cover, but it's much higher level detail, so don't worry. The boilerplate clauses are normally at the back end of the contract, and they are essential clauses, because whilst the majority of these are included as a matter of good practice, and they don't tend to be widely negotiated. So it's still good to be aware of what they are and what their purpose is. They normally include provisions along the following: assignment and other dealings, variation, waiver, severance, entire agreement, no partnership or agency, third-party rights, notices, governing law, and jurisdiction. Don't worry, I'm not going to go all of these in detail, but I've selected a few just to give a brief explanation of why we have them in. There is a reason. So the assignment and other dealings provision offers various options for dealing with the party's ability to assign, subcontract, or otherwise transfer their rights and obligations under the contract. Now, if the contract is silent on this, it means that a party can normally do the following without the other party's consent, and that is, they can assign, mortgage, charge, or declare a trust over their rights under the contract, and they can use a subcontractor to perform their duties while remaining liable for performance. That is, unless obviously personal performance is required. This means that if the parties want to restrict these abilities, they need to do so expressly in writing. While the customer is likely to want certainty of who is dealing with the supplier of the services, the supplier will likely want as much freedom to deal with its rights and obligations under the contract as possible, and that is particularly if there are any future corporate plans for sales or any restructuring. The other clause I wanted to go through is the variation clause, because in the absence of an express variation clause, any contract can be varied by agreement between the parties, as long as it's supported by consideration, so that can be payment, or if without consideration, if it's signed as a deed. Most contracts can also be varied informally, so that's by speech or conduct, without needing a signature. So that's why normally we'd want to expressly set out how changes to the contract can be made. That's for good contract management, and also so that any changes are made in an orderly way and properly recorded. The other important clause is the severance clause. So there is a common law doctrine of severance, but normally a severance clause is included and will clarify that the intention is for the contract to survive in case there are any provisions within the contract that are unenforceable, and so they are deemed deleted. Some severance clauses also add in case there are such provisions that are deemed deleted. They will also have a duty for the parties to negotiate in good faith to replace the offending provision with one that is valid, but there is no clause that can compel the parties to reach an agreement on this. And finally, I wanted to touch base on the third-party rights clause, which will normally exclude any third-party rights under the Third-Party Rights Act, unless these are expressly created in the contract. On this, it's important to actually identify what express provisions of the contract create these third-party rights. For example, it may be relevant where one of the parties wants its group companies to be able to enforce the confidentiality provisions, where their confidential information is also being disclosed to the other side. I've got a little poll here, just to check whether you guys have been listening to the beginning of my slides here. If the contract is silent on assignments and other dealings, which of the following can you do without the other party's consent? Please select any or all that apply. Assign your rights, mortgage your rights, charge or declare a trust over your rights, and subcontract your obligations as long as there's no personal performance. I'll give you a few seconds to have a think on this. Let's see. Yeah, I'll take it. So it's all of these. You can do all of these if the contract is silent, which is why if you want to restrict any of these abilities, then it's good to include an assignment provision. And that's it, guys. We've covered 10 key clauses under contract for services that come up for negotiation. Hopefully, it's given you a flavor of the key points that come up and what the supplier or the customer's takes tend to be. We've got a little time to go through any questions, if anyone's answered any. Let's have a look. Okay, so Susan, should we do a bit of back and forth? I'll ask you the first one.
Yeah, sure, go for it.
Let's see. That's a good one. When should a contract be signed as a deed?
Yeah, so this is a good question and one we definitely get asked often. So certain written agreements are under law required to be signed as a deed. So an example of this would be no mortgage agreement or powers of attorney. So if it's to be signed as a deed, then there are certain formalities that it needs to comply with. So just a quick maybe overview of the difference between a deed and a simple contract. So when a contract is signed as a deed, then there will be a 12-year limitation period instead of 6 years. And there's also no need for consideration to be paid under the agreement. So this won't really be relevant to a services agreement. There will always be some sort of consideration. But those are sort of the two main reasons why you would want to sign a document as a deed instead of as a simple contract, especially the liability period. So I suppose for a supplier, they might prefer a shorter liability period under the contract because they are the party who will be, providing the services. So they will probably prefer a 6-year limitation period, whereas the customer would probably want to keep the supplier on the hook for a bit longer, and they might want to go for a 12-year limitation period. Yeah, so that's sort of the main reason there. Should we have a look at another one?
Yeah.
So maybe one for you, Fran. So it's about insurance. So how crucial is insurance cover when negotiating limitations?
Oh, that's a really good question. So it's extremely crucial. It's extremely important to consider what insurance cover you have in place when you're negotiating limitations in a contract. I don't want to get too technical, but just to be very pragmatic, if you're a supplier and a customer is requesting a general cap or a super cap that goes beyond your existing insurance cover, then you would need to consider how commercially feasible it would be for you to obtain that cover in comparison with what you're getting paid under the agreement, for example, or at the same time, if there's any losses that you would want to exclude as a supplier under the contract, which the customer is pushing for them to be included, then naturally you'd need to make sure that you are covered for those under your existing cover. So hopefully that gives you a more practical understanding of why that is such an important thing to consider.
Yeah, good.
I think we've got time for a couple more, if you're happy with that, Susan.
Yeah, sure, let's go for it.
Right, let's have a look. This is an interesting one because it's a more specific clause that we haven't touched on. So, do we often come across non-solicitation clauses in a services agreement?
Yeah, that's right. We didn't cover it in today's session, probably because it's not really seen as sort of a boilerplate clause, and it also because we covered sort of a simple services agreement. It's not really a clause that we would include in a simple, straightforward contract, but you will definitely see that in more complex commercial arrangements. So just to start, so the purpose of a non-solicitation clause is to protect the business interest of the party benefiting from this clause. So when we have a look at it, or when we review it, or we draft it, we always need to make sure that it's proportional and reasonable to those business interests being protected. So a non-solicitation clause can protect a party against poaching of their employees, or even with the poaching of its customers. So our employment team actually recently presented a webinar on rogue employees and restrictive covenants, which looked at these clauses in a bit more detail. So you're welcome to find that on our webinar if this is of interest. On our website, if this webinar is of interest to you. But it is definitely something we come across, and it is also something that is negotiated by the parties. But like I said, it's just sort of finding that balance between the business interest being protected and then also the restrictive covenants that goes along with that. Okay, one more?
Yeah, fire away.
So the next question we got was, do we need a notices clause?
Yes. Yes, there is a reason. There is a reason. So there are common law and statutory rules for how notices can be served. But naturally, that means you'd have to check those when you need to serve a notice. So it's always good to have an express notices clause, because you can actually also then add to these existing methods, or if it's allowed under statute, you can exclude them. So if the clause is followed closely, it will tell you exactly how you can serve the notice and when it will be deemed received. So that can prevent an argument whether service has been achieved. It increases certainty. And if there is a clock ticking, for example, say you've got to terminate the agreement by the 1st of January, you've got to know when that notice will be deemed received. So that's why it's such a good clause to include. And also, if it's not complied with, then it gives you grounds for disputing the validity of the notice, even if you have in fact received it. I should say, though, it doesn't. A standard notices clause will not deal with how documents can be served in a litigation proceeding. So that will sort of be different, but it's still such a good clause to include for anything up to that point. Good question. I think we're approaching the end and time is almost up. So we'll close the Q&A. I've just got a few closing remarks just to thank you all for joining us today. We hope that you will have found this useful, and if there's any questions left, you can email Susan or me and we'll follow up on these afterwards. Don't forget to complete the feedback. We're always keen to get feedback, and also it gives you a chance to take part in our prize draw for a John Lewis voucher. We hope you join us again for another commercial and tech webinar. We thank you, and we hope you have a good rest of the week with the sun shining, and yeah, life is good. Thanks, guys.
Thanks, everyone.